Also, you are supposed to be able to describe, what is a well-diversified portfolio, how do you characterize the same, explain the impact of diversification on the residual risk of the portfolio. So as a general measure, diversification increases, the residual risk will go down. So diversification is a positive measure, that reduces the risk of the portfolio. But just to be clear, this reduces only the unsystematic risk. So diversification, you cannot diversify away the systematic risk on the portfolio. Also, you must understand how to construct a portfolio to hedge exposure to multiple factors. And finally, a little bit of a comparison with the CAPM and Fama-French models that we discussed previously. So, how does APT differ from CAPM and Fama-French? So, from an exam point of view, I would say this is definitely a must, almost a sure shot question. You will be expected to calculate the return of the asset using a single and a multi-factor model. Typically, this would show up on the exam. So you will be given a multi-factor model and asked to calculate the return of the asset. These are very direct questions, I would say. In terms of simplicity, these are normal to below normal, so they're very scoring topics. You must understand law of one price, very important as well. And this is an important point as well. So these three particular points will be highly tested on the exam. So from how I've been from my understanding of the exams, and I've been looking at this for the past 3-4 years now, these are very highly testable material. So let's get started. What is arbitrage? Basically, you are exploiting security mispricing to earn risk-free profits. So the risk-free part is critical here. You are not taking any speculative stance here. You are basically using the mispricing in the securities to be able to earn profits. So the risk is zero and the profit is positive. So basically it means that you have a riskless profit in place. So the first criteria of an efficient security market is that there should be no arbitrage on an efficient market. You should not be able to make money without taking risk on an efficient market. Basically, a factor model, something similar to CAPM and Fama-French that we discussed previously, should be able to decompose return into firm-specific and systematic returns. So firm-specific would be unsystematic, and systematic would be something that is inherent in the market. So we move on to the single factor model first. So this is how a single factor model would look like. Some of these slides are borrowed from the material that is published by the authors of the book. So as you can see from the slide, the return on using a single factor model is derived using this formula. Some similarities with the CAPM, I would say. You have a beta in place. You have ERI, which is the expected return on the security. So essentially, you have broken it down into the expected return and this factor. Beta is the loading or sensitivity or factor loading, whatever you might want to call it, or simply the beta as well. F is a surprise in macroeconomic factor. This could be positive, negative, but the expected value of F would be 0. So on average, it would be 0. EI is the firm specific event. So 0 expected value again, expected value of the error term for the EI would be 0, uncorrelated with each other and with F. So this is again a critical point. So for a single factor model, you must understand what this equation is. So this is a standard form of the single factor model. In the question, you would be given some factor, you would be given some expected return as well. And basically, you'll be given these variables and you will be asked to identify the return on the security using the expected return and the factor loading and the factor itself. This may or may not be given. If this is not given in the exam, take it to be 0. So basically what the single factor model tells us that the return on any particular security comes from two sources: the common macroeconomic factor This could be GDP, inflation, interest rates, anything. But we are typically taking only one of these in a single factor model. So basically what we are assuming is that the return on a security can be broken down, or can be, you can calculate a return on the security using a single factor model. You will be given only one factor, and the other factor would be a firm specific event. So there will be only one external factor and one local factor within the firm. This would be a firm specific event. This would be an external factor. So this could be GDP. This would typically be one of these. So an example of a single factor model would be something like this. Ri is equal to expected value of Ri plus beta of GDP into GDP. So F. So this could be GDP growth rate percent plus the error term or the firm specific event. The expected return plus beta. So this is the firm specific nature. This is also firm specific. This is related to the macroeconomic condition. This GDP could easily be replaced by inflation with interest rates or anything else. But there would typically be only one factor in a single factor model. So in the exam, you could be given beta. You would be given the expected return. You would be given the expected return, the beta, the firm specific event, and the GDP, and you could be asked to calculate the return on the security. So you have about five variables here. 4 would be missing. 4 would be known, sorry, and 1 would be missing. This is to be calculated. So this is a typical exam question that you can see on the exam. Now we move on to a multi-factor model. How is this different from a single factor? Basically, there's more than one factor, so it could be 2, 3, or any number of factors. So the factors we discussed previously: GDP, inflation, interest rates, policy rates, any other macro factor, or any factor that you can think of that impacts the security return can be basically used in this model. So essentially, just to give you a brief idea as to how this is actually done if you are supposed to calculate this. So you typically identify the expected return, you identify the factors which might influence the return, and then you run a regression analysis, and then you find out finally which factors are significantly influencing this return. So the multi-factor return, so this is a typical example of what you can get when you are trying to find out the return on any security that you hold. So an example of a multi-factor model. Essentially this could be an example. So as you can see, this is the risk-free rate. So as I told you before, we estimate the beta for each factor using multiple regression. We carry out the multiple regression, find out the betas, whether any of these are significant. If they are significant, they will have some beta. And then we can basically calculate ERI using this model. So beta is also called factor loading or factor sensitivity. So these are terms that can be used in the exam, and basically trying to confuse you on this, but they essentially mean the same thing, is equal to beta. So this is an example of a multi-factor model that we see here. Let's move on to the Fama-French 3-factor model. I believe that we discussed a little bit about this previously. So we discussed about this for a Fama-French model. This is a very popular model. So a lot of research has gone into this post this proposal by Fama and French, award-winning model. It uses these factors. So what are the factors that it uses? It uses book to market value as one particular factor. It uses a small size premium as a factor. So these are the two factors, 1 and 2. And the third factor is basically the market return. So this is the, this is a 1, 2, 3. These are three factors. Alpha could be the risk-free rate. Essentially, Fama-French, what they did was they ran this analysis for these factors for a large number of securities, and they found them to be, common across the board. What is a small SMB or a small size premium? A small size premium is essentially return of small. Basically, assumes that the apologies. So SMB is basically nothing but small minus big. So it says that the return on small firm would be in excess of a big firm typically, and this SMB is then put in here based on firm size. So say in the exam you could be given you would be given SMB for different so you could have 1, 2, 3, and the variables here are RMT, SMB, and HML. So HML is nothing but high minus low. Return of firms with high book to market ratio over those with low book to market ratio. Again, HML and SMB, these could be positive, negative, or 0 as well. So they will be 0 if they are if there is no distinction in a particular industry. So what you could be given in the exam is you could be given 4 or 5 cases of these. Say this could be 0.5, 0.6, 0.3, and 0.2, any random numbers, 0.4, 0.8. So for in the exam, from an exam point of view, you would be given these. The beta would be the same. So there would be a beta for this. There would be a separate beta for this and a beta for this. These would typically remain fixed. These would change. Alpha would also be given in the exam. So what you need to do in the exam is calculate the return in each of these cases. So just to be clear, what does SMB mean? So SMB is basically Fama-French assigns a premium to a small firm. So a small firm is expected to do better than a big firm on a short-term basis. So, and also, a firm with a high book-to-market ratio will do better typically over a firm with a low book-to-market ratio. So this is typically a premium that is built into the model. This is the model that we're using. Again, this is not something that the formula that you need to remember for the exam, but you need to know what each of these factors mean. The clarity on this should be there. Please let me know in case you have any doubts in this particular model. Now we move on to a particular case that so apologies for the heading. This should not be Jensen's measure. Basically I'll just cancel this. My mistake. So this is a case that we can discuss in the class. Basically we are given a 2-factor, which is a multi-factor model. For this airline, the final result is this. This is a typical exam question. Point 10 would be ER in this case, if you might remember. ERI. Plus this is beta for GDP. This is GDP. This is again beta 1, beta 2. Now this particular model tells us that on currently available information, the expected rate of return for Northeast is 10%. But if GDP increases by 1%, then the return on Northeast share would increase by an average of 1.8%. So if GDP goes up by say 1%, this factor will change by 1.8% and the return would go up by 1.8%. So this factor loading has this particular meaning in this context. And also for any interest rate decreases, the Northeast share would rise on an average by 7%. Just to be clear, this is basically IR decreases. So this is a sample case, a sample type of an exam question that you can see. So what you will be given in the exam, you could be given different values of GDP, of interest rate decreases, and then you could be asked to calculate returns, R1, R2, and then you could be asked to compare these two. So now we move on to APT. We have discussed multi-factor models already. So APT was basically developed by Stephen Ross. It is an award-winning framework as well. Similar to CAPM in terms that it predicts the security market line SML, which links expected return to risk. So ERI is linked to sigma. The path it takes is different. So compared to the CAPM, APT takes a different path. APT relies on arbitrage. So the no arbitrage principle, essentially the no arbitrage principle is the guiding principle behind APT. Ross's APT, three regular assumptions, you should be knowing these. This is a possible exam question. So what Ross's APT, which is the most common form of arbitrage pricing theory in the market, it says that security returns can be described by a factor model, either a single factor or a multi-factor model. It also says that sufficient securities exist in the market to diversify away the idiosyncratic or the unsystematic risk. This is typically the firm-specific risk. So this is not systematic in nature in the sense that this is specific to a particular firm. It may or may not be true or relevant for the other firms in the market. So it is not present for each and every security or portfolio. Also, no arbitrage, as I've told you pretty much many times before, non-APT. So no arbitrage condition should be satisfied for APT to work. Again, this basically says that, so these three are very much important. Securities can be described by a factor model. There is no unsystematic risk and no arbitrage condition holds. So I'll just move on to the slides. Apologies. So just move on to the slides that the author basically gives out. So these are a little more detailed in terms of what I have. Again, single factor. I hope you guys are able to see this. So fine. Single factor models. This is something that we have already discussed. This is something that I put in the slides as well. Multi-factor models. These are examples of factors that could be linked in a multi-factor model. How is beta calculated? This is again given in the slides I just presented. A multi-factor model equation. So what I'll do is I'll share these slides as well with you. So these are the textbook slides that the author presents. And I'll also be sharing you the original chapter. This is the chapter on APT. Chapter 11, I think. Yes, chapter 11. So the author, so I've just compiled it in these slides, and the author also gives a very nice presentation for this topic. This was something that we discussed. So this particular model has GDP and interest rate decreases as parameters. Now this is the interpretation of the multi-factor models that we use. So in the multi-factor model that we discussed here, this is the model. So the expected return can be explained by the risk-free rate, the GDP changes, and the interest rate changes. Beta would basically be a factor load on these individual changes. So if the interest rate, if say the GDP increases by 1%, if the GDP increases by 1%, and so the whole term will increase by beta times 1%. So beta percent change would be the final return in the final change in the expected return. So how do you interpret this particular case? So we see that the expected return on the security is the sum of the risk-free rate sensitivity to GDP times the risk premium for bearing the GDP risk plus the sensitivity to interest rate risk times the risk premium for bearing the interest rate risk. This is something that I've already told you guys. Now, what is the APT in detail? APT basically says that the securities can be described with factor model. So this is something that I already discussed. This is something that we already discussed. This is the definition of arbitrage. A zero investment portfolio has a sure shot profit without risk, without any investment. So what happens in the market is that if there is an arbitrage position out there, there would be multiple investors which will take large positions and bring down that arbitrage on a continual basis till it disappears completely. So as long as the arbitrage exists, there will be players in the market who will take advantage of that. So I'm talking about efficient markets. So in efficient markets, there should be no arbitrage, and any situation where it emerges will disappear in a matter of seconds or even less. So what the APT tells us that regardless of wealth or risk aversion, investors will want an infinitely large position in the risk-free arbitrage portfolio. So if you have a sure shot profit, then regardless of how much money you have or how much of a risk averse are you'll want to take as big a position as possible in that portfolio, because your returns would then simply multiply by your investment. So this is something I already discussed. Profitable arbitrage opportunities disappear in a matter of seconds. This is similar to the single factor model that we discussed, where F is some factor. For a well-diversified portfolio, this error term will approach zero as the number of securities in the portfolio will increase. So if the number of securities are, say, represent the market, say for the S&P 500, if you take a list of 500 securities, so they will be, that will form a well-diversified portfolio, and the error term would approach zero in that case. And also the associated weights, which is BP, will also decrease. This particular slide shows you the difference between a well-diversified portfolio and a single stock portfolio. So, and on the x-axis, on the y-axis we have the return percentage. On the x-axis we have the systematic factor, load, the F term that we have used previously. This is on the x-axis. So as you can see, there is a difference between the graph on the left and the right. On the left, you have here, as you can see, all the data points lie on this line. So this is a well-diversified portfolio where arbitrage is not typically possible. Now here you can see the expected return differs from the actual return because there is a possibility of arbitrage. And this particular slide basically asks you whether these two portfolios can coexist. So one has a sure shot return of 10%, another has a apology, not a sure shot return, but if you load the factor to 0, it means that the return is 10. This is the risk-free rate plus the error term. This is the risk-free rate plus the error term, which is 8. So these two portfolios, of course, cannot coexist as they won't be arbitrage free. Because if this is the case, then you'll basically buy low and sell high. So you'll buy at 8 and sell at 10. So arbitrage will be possible in this, and these two portfolios cannot coexist as a result. Now, this particular slide gives you an indication as to how an arbitrage opportunity can be exploited in the market when there is a difference in the expected return with respect to the macro factor. So macro factor so beta is simply the loading of this particular factor F, and E is the expected return as this beta changes. Please let me know in case you have any questions regarding the APT part that we just discussed. I'll be happy to take them as we go along, so that all of you are able on the same page and understand all the points very clearly. Now, when is APT model applicable? Now, this, as we discussed, is applicable mainly to well-diversified portfolios. And so individual stocks may not necessarily follow APT, as there might be firm-specific idiosyncratic risk which cannot be diversified away. Also, it is also APT does not say that there won't be arbitrage possible on specific securities. So it's possible that some components, some securities within the portfolio may be mispriced, but on a portfolio level, there should not be any mispricing. So essentially, on a graphical basis, it's possible that some of the individual stocks may not lie on the SML. As we saw before, this particular graph, it's possible that some of those stocks may not exactly lie on the SML, but on an average, they will, and they would be sufficiently close. Also, APT can be extended to multi-factor models. We initially discussed only one factor and one factor loading, but this can be easily extended to a multi-factor model as well. Now we move on to the another important point. This is probably the most important part of this slide. What are the differences between APT and CAPM? The first and major difference is that for APT, equilibrium will mean no arbitrage opportunities. If equilibrium exists in the market, there should be zero arbitrage opportunities in the market. While for CAPM, no arbitrage condition may not hold. So the model, at equilibrium may have arbitrage opportunities inherent. So it is based on a unobservable market portfolio. As we discussed previously, a market portfolio can have various definitions to you and me. If I'm an investor in Indian markets, a Nifty or a Sensex, could provide me a good idea of a market portfolio. But for an investor in the US markets, the S&P or the Dow Jones, those kind of indices would be a better market portfolio. So it's very, very possible that the market portfolio is, market portfolio should ideally have all possible securities that you can have, but this is something that is more of a utopic kind of a state. It is not always possible to observe this. This definition could vary from me to you. So the market portfolios that exist on paper, they are an average of sorts. The second point for APT is related to what happens when the equilibrium is disturbed. So if it is disturbed, and even if only a few investors are able to recognize this, they will move quickly and restore the no arbitrage principle, because till the no arbitrage principle is restored, there would be an arbitrage profit that can result. Also be clear that the expected return and beta relationship, the beta is a factor load, can be derived without using the true market portfolio. So we observe that for single factor and multi-factor models, a regression analysis can identify the beta variables. So you don't necessarily need to have an idea about the market portfolio to calculate the loadings. For CAPM, however, as we saw, market portfolio, this is a key identifier. So you need the market portfolio to be able to identify beta. CAPM also rests on mean variance efficiency. We discussed this previously, how CAPM is arrived at. It's something that is used, that is like uses the efficiency frontier, the research work carried out by Markovich, to basically come to so its derivation uses the efficient frontier. For CAPM equilibrium to take place, it's possible that it's important that a lot of investors recognize that mispricing. So CAPM again is more or less it's like an expected return. So if the expectation is there in the market on a there is a consensus in expectation, then they will move together to restore the CAPM equilibrium, and the expected return will actually be equal to the forecasted or the actual return on the stock. Also, CAPM describes equilibrium for all assets, portfolios, securities, individual securities. You can define equilibrium using CAPM, while for APT, it is typically on a portfolio level, not on a security specific level. We already discussed single factor APT. Now, what about multi-factor APT? It's possible that a multi-factor model could be a could also hold in a no arbitrage framework. So where multiple systematic factors can be used to explain the no arbitrage model. So how do you arrive at this? You basically identify factor portfolios, then you identify the factor loading using the regression analysis. Again, you just need to know what methods are used, which is largely regression analysis that is used to calculate these factor loads, not necessarily as to how this is done. So this detail is beyond the scope of the current aim statement. So what are the factors that you can choose? Again, this depends on your understanding of the markets or understanding of this particular portfolio. So factors which are important to the general performance of the economy could be things like GDP, could be things like interest rates, policy rates, or could be other things like productivity, or also related to measures like unemployment. Firm-specific characteristics, are these important? We have already discussed that firm-specific and general market factors should be differentiated. So a multi-factor model will have some firm characteristics and will have some generic characteristics about the to describe the return. So we look at the multi-factor APT, specifically a two-factor APT. It is similar to the one-factor case. Each factor will have a zero expected value. So E F1 would be 0, E of F2 would also be 0, and E of the error term would also be 0. For a two-factor model or a multi-factor model, these are some other important considerations that need to be kept in mind. Factor portfolios, should be diversified in nature. There should be little overlap between them. So otherwise, what will happen is that there will be some possibility of the factors being related to each other. So this is typically called multicollinearity in regression terms, where the factors have multicollinearity in them. So the factors should be diversified enough that there is no overlap in terms of their explanatory power. Because if that is the case, then it's possible that some of the factors are not as relevant compared to the others. Factor portfolios F1, F2 that we discussed, these could track a particular source of macroeconomic risk, but could be uncorrelated with other sources of risk. So you have to realize that macro is not the only possible risk that a portfolio faces. There are microeconomic risks as well. So we have to be wary and aware of those different types of risks or different types of factors that can influence the expected return. So what does a factor portfolio mean? A factor portfolio is essentially that you have mathematically it means that beta for one of the factors of which portfolio you are talking about, and zero for all the other factors. So it essentially boils down to a single factor model then, and the beta would be one for that factor. So it basically says that the portfolio or the assets can be tracked by using just one factor. So this again is a theoretical concept, not really much of a practical implication. But this is what a factor portfolio is mathematically related to, what we have studied so far. Where should we look for factors? I've already told you that macroeconomic factors are typically the most common that impact portfolios on a general level. Microeconomic factors could be important as well. Systemic risk factors are required. So as we discussed, Ross's APT, some of the other work that Ross did with these gentlemen, Chen and Roll, related to using these factors. So these factors are basically productivity, inflation, it could be expected or an unanticipated inflation surprise in other terms, excess return on corporate bonds. So this could be a premium on the corporate bonds, on government bonds as well. So these are some of the factors that they used. You are free to choose your own factors as long as they make logical sense, as long as you have a regression analysis to back that up. And we have already seen the Fama-French model. So if you might remember, Fama-French used basically three factors. One was the market return, another was the small size premium of the company, and the other was the book to market value premium. So Fama and French, in crude terms, use these three factors in their regression analysis and found them to be significant over a large number of securities for a large period of time. This is something that we already discussed. In terms of comparison of Fama-French, CAPM, and APT, this is an important slide, as I've already told you. So you need to be aware as to what are the factors, what differences are there. For CAPM, what is the equilibrium point? For APT, what is the equilibrium point? Fama-French is neither, falls under APT or CAPM. It is a different multi-factor model, or three-factor model to be specific. APT would be a single factor or a multi-factor model. CAPM, as we have already seen, is a single factor model. Now, what is the multi-factor CAPM? And it's possible that the market, different market portfolios can be included in a capital asset pricing model. So multi-index CAPM in that case would simply be the risk premium for market one. So I'll just show you this on a slide. Essentially, I'll just define, what a multi-index CAPM is about first, and then we'll go through this slide. Apologies. Let's go to the full screen. Just to be clear, multi-factor model, multi-factor CAPM is something that can be given. We already saw CAPM. CAPM is ERI is equal to RF plus RM minus RF into beta. Beta in this case, beta M or beta P. So what happens here is that we are using multiple a multi-index. This is single index CAPM. Single index. Now if I'm talking about a multi-index CAPM, it would simply be this model, but some more terms would be added. So we can just mark it as RM1 minus RF into beta M1 plus RM2 minus RF into beta M2. plus so on. So, this is an example of a multi-index CAPM model where, where you are not able to narrow it down to a single market risk factor, but there are multiple market portfolios which are then used to classify this multi-index CAPM. So not so important from an exam point of view, but just from theoretical understanding, you need to have an idea how to find out the multi-index CAPM. Let me go back to the previous slide. So what does this slide tells me? It basically is comparing the multi-factor CAPM and the APT. So as we saw before, the multi-factor CAPM would include multiple indices, multiple market indices, and the APT could include those market indices. It could include any other factors. So whatever satisfies, whatever gives you a no arbitrage situation, that would be an APT model. So an APT model could be related to macro factors as we saw. So the factors could be GDP, inflation. They could also be market factors as well. So what happens here is that a multi-index CAPM will typically inherit risk factors from a broad group of investors, which they deem important enough to hedge. So these investors would have a different definition of their indices, and this would basically cause a and these group of investors could have a different market index, and the risk would be derived from those individual RMs. The APT does not make a distinction on that front. It does not tell you where to look for risk sources. So the risk part here, that is the main difference between the multi-factor CAPM and the APT. The risk is clearly defined for a multi-factor CAPM. It arrives from the investors that are hedged. So whatever risks are out there in the market that are important enough to hedge will be considered in multi-risk CAPM. However, APT does not give you a treatment as to where to look for those pricing sources. So this basically finishes APT. Please let me know if there are any queries on the APT front. I have pretty much covered APT in full. So this is a textbook chapter which relates to arbitrage pricing theory. I'll be sharing this with you as well. A lot of the examples come from this this particular book. Very interesting. APT, is something that is the source of a lot of research out there in the market. This is very important from an arbitrage point of view, from an efficiency of the markets point of view. So it's not just important from a financial risk perspective, but also from from a finance knowledge perspective as well. We already looked at well diversified portfolios. We have looked at these cases which were there in the slide. So just like to pause here and I expect you guys to be able to throw some questions at me in case you have not understood anything, in case you feel that there is something that I have gone too quickly over. Maybe I can just go through that part again, but just to be clear, CAPM and its applications, and now the APT, these are three very highly numerical topics in this chapter. The questions that you can expect from these, you'll be given the factors, you'll be given the loads, and then you will have to calculate the returns, the expected returns based on those variables. So this is what the numerical you can expect in terms of theory. Again, a wide variety of theory. The assumptions could be tested for the theory. What else could be tested? Things like what does the beta mean, or what how does it impact the calculation? This could something be tested from a theoretical point of view. Again, I've covered more or less everything. A multi-factor CAPM, as I discussed before, could be something like this, where M and E are different markets. So I essentially used M1. They have used M and E as different markets. I'll just like to quickly sum up what we have observed in terms of before that, I'd expect you guys to be able to answer this. I hope this is clear. I'll just try to increase the size of this. I hope this is clear. Now I want you to have a look at this particular case, so because this would give you an idea as to what your understanding of APT is. Please give me your answers. I'll give you 2 minutes to answer this, and then we can discuss. Please have a look at this particular case study. Please feel free to post your doubts or clarifications or whatever your analysis of this particular case is on the message board, so that I can see what lines you're thinking along. So I'll just like to discuss this with you all now. Essentially, what we are given is a single factor model where 2% can be assumed to be the risk-free rate, and 1.2 into, so 1.2 is the beta or the factor load for percentage change in oil prices. Now the first part basically tells me that I'm living in a economy which is heavily dependent on oil industry profits. So does stock X represent a useful asset to hedge my overall economic well-being? Again, just to be clear, these are not options. So these are some particular, so they don't have any specific answer. There is no right or wrong answer as such, but there is a well-suited. So this is not an objective right question. Now you won't expect this question on the exam, but from an understanding point of view, this is important. I'd just like to discuss here. So as I told you, as I've discussed, the stock X, will this represent a useful asset to hedge my overall economic well-being? So say if I'm a retiree or a pensioner and I have this stock on my books. Now, as you can see that the local economy is very highly dependent on oil industry profits. So if the economy does well, then what happens here is that my stock return is expected to be high, since this would be multiplied by 1.2. But however, if it does not do well, then what happens is that the oil prices, or apologies here, so if the oil industry profits are high, if there is a lot of supply of oil in the market, then the prices would be low. So my return would be low if the profits are high. So I'm able to hedge my risk if I am living in this country. Why? Because whatever shortfall is there because of these oil prices, they will be offset by the industry profits. So if the economy is doing well as such, this particular stock won't. So this is a hedge in terms of dependency of the oil. So if I'm an oil producer, I'd like to be invested in this stock. Why? Because if my industry profits are low, my supply dwindles, then the oil prices would rise and I'll have a positive return on this. But however, if my oil profit is doing well, if the industry is doing well, the profits are high, the supply would also tend to be high and the prices would be low. I won't do too much on this stock, but this would be a good hedge, because then it supports me in my times of crisis. Now what if I live in Massachusetts, where most individuals and firms are energy consumers? In this particular case, as you can see, most of the firms are energy consumers, so the demand, there is likely to be a demand supply gap. So there are no, if the supply is not high enough, these consumers will typically drive the prices up. I want to be invested in this stock, as most of these guys are energy consumers, and there might be a monopoly of the supplies in the market. This will cause my return on this particular stock to be higher than usual. Also, the third point is on similar lines. If the energy consumers are very much higher compared to the energy producers, this will create a demand supply gap. So my percentage change in oil prices will be higher. So will high oil beta stocks have higher or lower expected rates of return? So if that be the case, percentage change would be very high, and the beta, if for beta, if the beta is higher, that would basically mean a higher return as well. So as you can see, the return will be driven by two factors. One is basically one is beta, and one is the percentage change in oil prices. So these two factors are what will drive. If this is positive, then a higher beta is preferable, as in this case. So I hope you are clear on what this particular question is about. So I'll just like to summarize what we have discussed in multi-factor models and APT. This again is a very important slide. You can expect around 3 questions from APT and multi-factor models. And the questions could be related to assumptions. One of them should be a numerical that will give you the factor loadings and then ask you to calculate the returns. Now in summary, what have we learned so far? We have used multi-factor models to improve the explanatory power of the single factor models. So basically multi-factor models have more factors coming in, so the explanatory power is better than single factor models. So this is the point that we are relatively clear on now. On the second point, so the second point is basically summarizes what we have learned about allowing for multi-factor models. The security market line will also then be multidimensional, and the exposure to each risk factor will contribute to the total risk premium of the security. The third point that can be summarized from this is that a zero arbitrage opportunity, what does that mean? Basically, you can have a zero investment portfolio that will result in a sure shot profit. And a large volume of trades will essentially move into these arbitrage opportunities and wipe this arbitrage out. So for security pricing, say for bonds or for other types of fixed income pricing, you are removing arbitrage, so they inherently satisfy the no arbitrage condition. So there should not be any risk-free arbitrage opportunities. And for equities as well, we have seen APT. If according to APT, they have to satisfy no arbitrage condition. So if there is any arbitrage in an efficient market, it would be wiped out. What is a well-diversified portfolio? This is something that we already considered. A large number of securities are there, and the proportion in each of them is sufficiently small, so that a market portfolio can be considered well diversified, as it will have a lot of securities in a variety of industries. So there is no unsystematic risk in the market. So these points relate to multi-factor APT and multi-factor CAPM. Basically, the no arbitrage condition and equilibrium position at CAPM that we already discussed. Also discussed here is the fact that APT does not have restricted assumptions like the CAPM. And of course, the unobservable market portfolio, which is a very big drawback of the CAPM. For every individual market portfolio may represent a different entity.